Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following in the BNN Bloomberg newsroom. Ontario Power Generation and the New York Power Authority have signed an agreement on nuclear energy. The Memorandum of Understanding outlines a framework for collaboration on the development of advanced nuclear energy technologies, including large-scale and small modular reactors. New York's governor and Ontario's premier have also signed a declaration of intent, pledging continued cooperation between the state and province. Canada's retail sales fell 0.2% in October for a second straight month, led by a drop in clothing as well as the food and drink segment. However, there are signs of a turnaround. An advanced estimate from Stats Can indicates retail receipts rose 1.2% for November. Still, some economists believe slowing population growth and a fragile labor market could weigh on retail demand heading into 2026. Shares of BlackBerry down sharply today. The Canadian software developer posted profit and revenue for its latest quarter that came in above Bay Street expectations, but investors may be focusing on its revenue decline. Sales fell about 1.3% compared to the same period the year before. Now, on the upside, BlackBerry raised its full-year profit and revenue forecast, boosted by growth in its QNX division. Shares of Lundin Mining are up after the Canadian miner agreed to sell its subsidiary, Lundin Mining US, to Talon Metals. The subsidiary holds the Eagle Mine and Humboldt Mill, and the deal is valued at about $84 million. Once completed, Lundin will have a total holding in Talon of 20%. The miner says a combination of Talon and Eagle will create a pure-play U.S. nickel company. Here is where we are on the market so far today. The TSX gaining 390 points. It is set for another record close, sitting right now at 31,831, so up 1.25%. South of the border, the S&P 500 gaining 59 points. The Dow Jones a 211-point gain, up 0.4%. And the Nasdaq a 274-point move up, move of 1.2%. Stocks rose on Friday today, driven by gains in technology, as the artificial intelligence trade seeks to recover from the volatility of recent weeks. A cautious outlook for Nike has raised concerns that tariffs may continue to challenge the outside of tech sectors in 2026. Let's go to Jeff Phipps, trading strategist, portfolio manager at Picton Investments. Thanks for joining us today.
Thanks for having me, Marilla.
So the change in sentiment, is this coming from the Micron results?
I think what we've been going through is a bit of a changing in the narrative with respect to AI CapEx. And this has related to a change in leadership internally. I would also make the case that what we've seen in terms of the recovery over the last several months, economically and in markets, it has been accompanied by some very accommodative sets of both fiscal and monetary policy. And that has also helped drive some of this rotation that we're continuing to see.
So it's rotation, but really the past couple of days, meaning the last 2 days, we've seen things perk up again. Is this the Santa Claus rally many had expected?
To some extent, I think it is, yes. Overall, we did have a pretty long period of that rotation playing out. Overall, the view is for us going into 2026 is that the backdrop of decent macro fundamentals and a fairly sort of, if you want to call it an orderly deflating of some of the more speculative parts of the AI bubble, that can continue. And macro conditions are aligned with that continuing. All
right. You describe AI as a double-edged driver. Can you explain that?
Absolutely. There are different aspects to it. So on one hand, we've had this recovery, particularly in the United States. This has been called sort of a K-shaped recovery or a very not normal sort of labor cycle. So to some extent, the lower end consumer has not necessarily participated economically in the recovery and growth in the U.S. economy. AI has been one part of that. I think tariff probably has something to do with that as well. But certainly we are seeing, I think, some impacts of AI on hiring, as well as where investment goes.
Okay, let's talk about the new Fed chair expected in May and likely to favor lower rates. That's the way it looks right now. How do you think that'll work out into the economy and the outlook for 2026?
I think that you're right. We are likely to have a Fed chair that is sympathetic, to put it lightly, to the White House views in terms of monetary policy. We know that because we are in this period right now where globally, to a large extent, where fiscal policy has taken on a new role of dominance, that the tools of monetary policymakers like the Fed, like the Bank of Canada, they aren't that well suited to curb things like embedded inflation from things like tariffs, from things like fiscal impulse. So I think the view is we are probably going to see a couple more cuts from the Fed. They probably skew to later in the year, and it's more likely than not that we do get a pause in January.
Okay, we had retail spending in Canada sort of drop for October. It looks like there might be a bounce back in November. We're not really sure yet. What do you expect as far as bank cuts next year from the Bank of Canada?
So the forward market has really priced the Bank of Canada pausing. There's even a little bit of pricing towards a hike next year. You mentioned some recent macro data in Canada. Headline data, including jobs data, has been a little bit better over the short term. Again, the internals are a little more mixed. I would say that this is probably, this and the focus on inflation is causing some pause in terms of how the Bank of Canada is thinking about their cutting cycle. Again, I do think there is a little more risk in Canada to some of those fiscal measures not providing the rubber hitting the road due to some of the lack of productivity, growth, and capital formation that we've seen in Canada that appears somewhat structural.
Okay, let's talk about sectors that you think will perform next year. What are you looking at?
Well, this rotation and broadening out trade, which is not without risk. I do think 2026 is going to be the year when the market determines which domestic market fiscal programs are actually going to provide a return on investment. But assuming that we don't have any problems in the bond market or credit, I think the more cyclical parts of the economy can continue to perform well within the market. That includes consumer discretionary, parts of industrials and financials. But I'd caution that some nuance is required. For instance, large cap banks, both in Canada and the US, they are pricing very high multiples. They are pricing an early cycle environment. So a lot has to sort of go right for those to grow into their multiples. Having said that, there are a lot of areas within those sectors I mentioned that have been overlooked for a number of years at this point.
Okay, so equities, I think most do expect to do well next year. What about bonds?
We are a little cautious on bonds. I think I did mention to you that that 2026 may well be the year that markets start dissecting the differences between a lot of the domestic economy's fiscal programs that, for now, have sort of been the tide that has risen all ships. When we look at historical periods, when the market starts applying a little more of a skeptical eye toward deficit expansion relative to the return on investment of that deficit expansion, looking at the long end of bond markets is often a pretty important thing to do. So again, we do have a lot of credit supply hitting the market in the United States next year. We do have a sort of an uncertain government funding mechanism for next year in the United States, including Besson potentially trying to just rely on the bill market like Yellen did. So again, we are a little bit more cautious on the bond market. Things still can go right. But our general view with respect to bonds is that we cannot expect in a portfolio of bonds to be a useful diversifier the way they have over many decades.
Interesting. Okay, Jeff, I've got to leave it there. I'm out of time, but thanks for your time.
Thank you so much.
Coming up next, as we mentioned, Canada's retail sales fell 0.2% in October for a second straight month. We'll get into the details in a moment. Retail sales fell by 0.2% in October. Let's dig into the numbers with Randall Bartlett. He's Deputy Chief Economist at Desjardins. Thanks for joining us today.
Oh, my pleasure. Thanks for having me.
So less spending on clothing, food, and drinks. Was there any specific reason you saw for lighter sales in those categories for October?
Yeah, actually, so food and beverage was very much focused on what we saw in BC. So we saw that we look at what was going on with sales of beer, wine, liquor retailers. Is very much a function of labor disputes in BC that held down that category, and ultimately we do expect that to come back in November as the strike ended in the middle of the month, and ultimately shouldn't be something that's like a long-term drag on retail sales. On the clothing side, I mean, not a ton to read into it. We thought that ultimately, at the end of the day, broadly sort of a reflection of the broader weakness we're seeing in the Canadian economy, in part because of the obvious uncertainty coming from the trade war with the U.S., but also the headwind to the Canadian economy from slowing population growth.
Okay, so let's look at what Canadians were buying. Let's start with furniture and appliances, so the big ticket items.
Yeah, we've seen that when it comes to furniture and appliances, this is a trend we've seen, in across categories where it broadly seems to be a reflection of housing market that's, not declining anymore, but it's sort of grinding sideways as we've seen sales activities sort of middling over the last few months, and so very much a reflection we think of a housing market which is shaking off some of the uncertainty from earlier in the year, but it's still subject to weakness in the Canadian labor market, and also the headwind that is interest rates and stretched affordability in Canada.
What about vehicles, though? Did that make sense to you coming back in the fall? Perhaps more of the tariffs unwinding, people felt better about buying cars?
Yeah, for sure. It's one of those things where we saw a lot of purchases move forward to the end of 2024, beginning of 2025, as folks wanted to take advantage of vehicle rebates at that time, get ahead of the tariffs. But now that we've seen some of the counter tariffs come off of Canadian imports of motor vehicles on the U.S. content from the U.S., we've seen that it's got a little bit easier, we think, for Canadians to purchase those vehicles. Additionally, what we've seen is that again, like the labor market hasn't been as weak, I think, as a lot of folks anticipated earlier in the year. Income growth has been stronger, and so all of that sort of supported a bit of a rebound in auto purchases in October, particularly relative to the big drag we saw in September. But we're not necessarily out of the woods yet, as we still have those headwinds of the trade war that hangs over the Canadian economy and that declining population growth in Canada.
The advanced estimate, as you know, showed a rebound for retail spending in November, but are early estimates reliable?
Early estimates are generally quite reliable. I mean, we saw that retail sales fell by 0.2% in October. The flash estimate was for a flat print, so it came in a bit weaker, but it was still fairly close to the actual number. Generally, it's a pretty good read on where things are going. It accounts for about 60% of retail sales, so it is likely to be somewhat different, but seems to account for the bulk of it. And when we unpack that number, it looks like about half of it was probably prices when we look at the seasonally adjusted CPI for goods. And so the rest of it is going to be volumes for November. So suggests a bit of a tailwind to November GDP growth as well.
Okay, so would you start or expect to start seeing some of the holiday spending build up in that month?
Yeah, so we are going to start to see that in November with Black Friday. So that's going to be part of that calculus, and then continuing into December. Always a bit of a tough read is to get a sense of what's happening on a seasonal basis. This data is seasonally adjusted, so it will pick up the strength going into the holiday season already. Just adjusting for what the typical spending pattern is. So we'll see what that looks like going forward. Last year we had the GST rebate, you'll recall, that started in the middle of December, the GST holiday rather, that allowed for some GST to be removed on some consumer items like toys and games, as well as eating at restaurants. And so we'll see how that plays the seasonal factors and how that affects the data in December rather, going forward.
We also have a declining population in the sense of immigration has been sort of held or moved down for targets, especially with students. I'm wondering what your outlook and how your outlook has changed as a result of that change in population.
Yeah, so the read we got on Q3 population was much weaker than we had anticipated, and was much closer to what the federal government would need to see in order to hit its targets. And so we've been reevaluating our forecast since then, and we're still of the view that population growth is probably not going to be as weak as the federal government's targets would suggest, but it is going to be weaker than we previously anticipated, and we'll be putting out our updated population projections very early in the new year to walk folks through where we think things are going.
All right, Randall, I'm going to leave it there, sir. Appreciate your time. Randall Bartlett, Deputy Chief Economist at Desjardins. Coming up next, shares of Nike trending down after a beat on earnings per share and revenue. We'll talk about what's driving the sell-off in just a moment. Shares of Nike are down more than 10% today after their latest earnings report reflected weaker sales in the China market. However, my next guest says the brand still resonates with consumers and will eventually turn a corner. Let's get more from Zachary Waring, equity research analyst at CFRA. Thanks for joining us today.
Yeah, thanks for having me.
So in China, are they losing market share to competitors? Is that what's going on?
You know, it was an interesting quarter. They did really well in North America, but like you said, China was extremely weak. And, you know, we do think they are losing a little bit of share in China. The CEO stated, you know, they had older inventory, outdated inventory, and they had to use heavy promotions to offload that inventory. So we think part of it is market share, and we think part of it, you know, has to do with the macro economy in China.
All right. So let's talk about North American sales. You said they did better in the U.S., but have tariffs hurt them in North America? Because I know they produce some in China.
That's correct. Yeah. So they actually produce a small amount of, you know, their inventory in China, but most in Asia. So, you know, the sweeping tariffs really hurt them along with other apparel and footwear brands. But, you know, it was worrisome that, you know, gross margins, you know, compressed 300 basis points. And we do think that, you know, compared to peers, that's an underperformance. You know, you had a lot of brands on and Deckers that, you know, didn't see any impact of tariffs. They were able to offset most of tariffs, if not all of them, and raise margins. So, you know, they are seeing that as well.
What are the other companies doing to offset tariffs, for example, that Nike isn't?
You know, I think a lot of it is raising prices and, you know, a little bit of supplier relations, you know, supply chain mitigations and cost cutting. So, you know, they're just not doing a good job compared to peers, you know, especially some of the competition that people think they're losing share to in the U.S., like I've stated on, and then Deckers with the Hoka brand and UGG. And so, yeah, it was just kind of a weak underperformance in margins. And then obviously the weakness in China. Another thing that worries us is the digital decline. You know, they saw double-digit decline in their digital. And we think that has to do with the, you know, the shift to make it a more premium, you know, site and platform. And we just don't know that that's going to work long term.
Okay, so they have a new CEO. He is a year or so into the turnaround strategy at this point. I know that some of the early focus has been on, as you mentioned, getting rid of a lot of the older inventory, just selling that off, and also strengthening relationships with sellers, which they lost touch of when they tried to go more just digital. How are they doing on both of those fronts?
Yeah, I think they're executing well on that part of the strategy. You saw wholesale revenues increase, you know, 8% this quarter compared to Nike Direct, which was down 8%. So they're doing a good job to push inventory to, you know, their wholesale partners, and I think that strategy is working. But we just don't, you know, and we like this, you know, the move into focus on sport again. But we do think that the turnaround is going to take a little bit longer, and you kind of saw that this quarter, and I think that's what the stock reaction is showing you today. And I do think that there are better options within, you know, footwear and apparel that you can go to and get a return over the next 12 months. And we think that Nike's a hold here. We're neutral on the shares. We do think the long-term story is still intact, but we do think it's going to take a lot of time.
Is there a lack of innovation, would you say, for Nike in comparison to its peers?
I think they're able to turn that switch on pretty quickly. They're obviously one of the best capitalized companies, especially in retail in the world. So we do think they can spin there, and we think they're doing a good job there. So I don't think that's going to be an issue for them. I think their products over the last few quarters have improved significantly. And they've been able to, like you saw this quarter, move inventory out of North America. But, now the focus got to be on China.
What about partnerships? How are they doing with partnering with the right brands to get a boost for the company?
Yeah, they did well. I think that the Skims partnership was a good idea. That's obviously a really hot brand. It really resonates with the younger consumer. And it's, obviously more of a female brand. So, I think that's a good partnership. But in the grand scheme of things, they can't partner with everyone. They've really got to focus on their core brands. And I think they're doing that. I think the new CEO's really focusing on sport. Running was a really good, strong category for them this quarter, and that's been strong over the last few quarters. So, I think they're doing a lot of the right things. I think, a couple of partnerships here and there is not a bad thing, but in the end, they really need to focus on their own brand and really bring what product, what consumers want to the shelves.
Zachary, can you also explain a little bit more about their digital platform and what you see that has changed there that's not working for them?
Yeah, so it's tough to know exactly what's going on within that, within the platform, but you can see this quarter that sales declined, I think 13%. So a big double-digit, decrease there. And they have focused to more of that premium. There's not a lot of promotional activity on the site, on the platform, which I think is going to hurt the company. I do think that, a lot of consumers go online to shop because of the deals that they can find. And, at the end of the day, Nike's a mass appeal brand. They're trying to get as many consumers as they can to their site, and they're not a premium brand. So, focusing on that, I think, is probably not the right direction. But, I guess we'll see. This is only one quarter. A double-digit decline, might be okay if they're just offloading some inventory. But, I think we'll have to see a couple more quarters before we can really get the story there.
Got it. Zachary Waring is the equity research analyst at CFRA. Thanks for joining us today.
Thank you.
All right, a quick look at the markets before the end of the trading day and the end of the trading week. The TSX poised for another record close, a 308-point move up at 31,747 right now. We'll give you the closing numbers and final numbers when we come back. Stay tuned. Here are the closing bells for the end of the trading day, the end of the trading week. At the Nasdaq, Bowman ringing the closing bell, and in New York, Orla Mining ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX, another record high for the TSX today. The record close at 31,755, a move of almost 315 points up, or 1%. The S&P 500 gaining 59 points, just short of 60, up 0.9%. And the Nasdaq moving 301 points up today, 1.3% to end the day at 23,307. Let's take a look at the movers in Toronto. We're going to start with Janison Mines, moving up more than 7% today, a gain of 26 cents. The shares ending the day at $3.80. Celestica also gaining today more than 9%. That's a $34.35 gain, taking shares to $407.37. It's up 206% over the last year. NextGen Energy also gaining 7.5% today. That's an 88% move up to $12.59. And on the flip side, for the worst performers, BlackBerry, 14% drop, 85 cents loss per share to $5.18. Curaleaf Holdings, a cannabis holding here, also dropping today. So it's 6.1% down. That's 27 cents per share, or $4.14 is where it ended. Discovery Silver losing more than 3% today, 28% drop, taking shares to $8.40. But look where it is for the year, up 1,154%. All right, let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with more on what's been going on. Stephanie, let's start with Finning International. They've had an incredible run this year. Tell me about that.
Yeah, that's right, Marilla. So happy Friday. We had a story out this morning focusing on Finning International, a heavy equipment company, and really underscoring the impressive run it had this year, like you were mentioning. It's, in fact, one of the best years it's had in all time. It's moving nearly 100% higher this year, thanks to a mining boom, a robust financing environment that's really cranking up the demand for its heavy equipment that helps it with these operations. That, and I spoke with a few shareholders and analysts who expect that momentum to continue into next year because of the construction boom. Recall that there's been this huge infrastructure spending push from the federal government, earmarking about $115 billion over 5 years in the budget. So Finning, a company that deals Caterpillar heavy equipment, has had its best run since at least 1987. That's about as far back as our data goes, but it's probably one of its best years since the company started trading in 1969. That's making Finning one of the OG TSX listed companies. So a metals boom, a robust financing environment for the metals space, like I mentioned, is what's driving a lot of the demand for vehicles like bulldozers, excavators, everything that's required for these operations. And that's especially the case after the metals rally with gold, silver, and copper reaching all-time highs at varying points of this year. So speaking with a few shareholders like Mark Rutherford at Mar Investment Management, they've been a shareholder since about 2016, and they have about 2.6 million shares since I last checked. And he said that it's really this change in tone around infrastructure building that's helping a lot of engineering and construction names. And this is one of the more tangential companies that would also work or benefit from that run, especially with its construction business. So whether it's a high-speed rail or a natural gas pipeline, you need the equipment to get these projects off the ground, and that's exactly what Finning does. It rents, it sells, and it also has a product services part of its business that has also seen a lot of robust demand. So its equipment backlog, kind of an indicator of demand, has reached about $3 billion heading into the new year. And that's what has RBC analysts saying that it's positioning the company pretty well for 2026, Marilla.
All right, sounds good for them. Let's get to BlackBerry. On the flip side, shares dropping today, double digits. What happened there?
Yeah, in fact, it fell as low as 15% at its bottom there. So that was its biggest intraday drop since April, and it dragged the share price to its lowest level since September. And so BlackBerry used to be known for its smartphones years ago, but now serves as more of just a general software company with cybersecurity business. It reported results after the bell last night, and even though those earnings came ahead of what analysts were expecting, some analysts flagged that there was the company's QNX operating system business missed estimates and is also appeared to be tracking a lower growth trajectory. RBC analyst Paul Treiber added that a lot of the upside in the results came from a one-off revenue item from the secure communications business. So it's given a bump up from something that's probably not going to be repeated in other quarters moving forward. And I got a chance to connect with TD Cowen's John Shao, who said in his notes that even though his team thinks BlackBerry's set up well for the next year, a lot of that is already priced into the current share price level. So that even though analysts are describing this quarter as solid and that the earnings were strong, there are a few shortcomings in the results that's having analysts concerned and shareholders react to this degree, Marilla.
All right, Stephanie Hughes, appreciate the update. Have a good weekend.
You too. Take care.
Coming up next, markets on track ending the week higher. The TSX, another record close. And shares today in Oracle moving higher, bringing up some of the other tech as well. We're back in a moment. Markets are up for the end of the week, the U.S. ending the day higher, thanks to gains in the tech sector. For more on whether this could be the start of a Santa Claus rally, let's go to Kim Forrest, founder, chief investment officer at Boca Capital Partners. Thanks for joining us today.
Thank you for having me.
Why is tech rebounding? Is this Micron reporting that's sort of resounding?
Micron, and then the whole TikTok news where Oracle is getting a piece of it. And, for services, not just, a gift, but they will be getting some of the revenue for hosting it on their, the American version of TikTok on their data centers. So all of these things point to more and more data centers being built. And the report that Micron gave was really encouraging with respect to what its pipeline is. Now, this all could come to a grinding halt for whatever reason if we decide that we don't need these data centers. But as of now, it looks like we are all steam ahead for the data center revolution.
Has this signaled, you think, perhaps a mood shift for the end of the year?
It has. There were real fears coming in as people did the math for OpenAI, for example, that its revenues are pretty impressive at $20 billion, but it's committed trillions of dollars for data centers. So that math doesn't necessarily add up. And I think with the competition heating up from Meta as well, that Gemini is a much better product than it has been and is really breathing down the back, or maybe even has exceeded what OpenAI can do. This really gave investors some pause about how many models are needed and, who's going to pay for them. So that was the concern earlier in November, and we've forgotten it all by these really good numbers by Micron and some other announcements.
So let me ask whether you like Micron long-term as an investment. Are there other stocks you prefer for 2026?
Sure. Well, I'm going to hold on to Micron for sure. And, it's a volatile stock and it's a cyclical stock. Now, what happens generally is there are few players in the products that it makes. It makes two of them. NAND, which is it used to be the kind of memory that goes in a camera or, a little dongle that goes off of a computer, or DRAM, which is it's memory that goes on a server chip or a CPU to help usher in data to the processor. And both of these things are very cyclical, but they're cyclical for a great reason, that there's a handful of makers of these products. And they all seem to add capacity at the same time and all seem to overproduce, and that makes the market go down or the price of their products go down. Well, this time it could be different. Everybody seems to have a different high bandwidth product as opposed to it being more commodity-like. So I think for the foreseeable future, which is months, not years, it's probably a good idea to hold on to Micron if you have it, and maybe take a look at it if it would dip for whatever reason.
Nike, of course, reported earnings. Investors were not very happy. What are investors seeing there, you think, that they don't like or that they're not appreciating the attempt to turn around?
Sure. Well, investors are time conscious, and, Nike's been having problems for almost a year now, and they don't seem to have made progress. And this is the big quarter in which they should have shown some progress. This is leading up to the holiday season, where it's vendors that purchase its products and sell, like sporting goods stores and department stores, should have, seen a good pull through for them. And it wasn't necessarily a great year for that. But really, an area of disappointment was China, and that was down by 10%. And anytime you're down in a region as important as China is, 10% is really far. So investors were very unhappy with the company, and they don't seem to have answers about how they're going to turn it around.
Okay, I do want to skip to what you see for next year. Are there themes in investing that you are kind of adhering to for next year?
Sure. Well, we usually have a pretty long timeline, like 3 to 5 years. AI is still going to be important. And this is going to sound crazy, I'm not a believer necessarily that LLMs are AI stop, period. We don't need to do any more development. I think they're very interesting. I certainly acknowledge that they help, large language models help people ask questions of a computer much better than we do in, say, Google or do a search on any other kind of search engine. But I don't necessarily they are the thinking machines that people are really believing that they are. So I'm not thinking that LLMs are going to take over. What I'm looking for is the time of the smaller models, targeted models, and it could be language models or other kind of models that are solving discrete problems and that add high amounts of productivity. As of yet, we're not seeing tremendous amounts of productivity, largely because the models aren't all that right with the data they return. But it will improve over time, but I'm still looking for a different kind of theme coming out. But until then, we're going to keep on going with the tech theme.
Okay, I will leave it there. I appreciate you joining us on the show. We have Kim Forrest, founder, Chief Investment Officer of Boca Capital Partners. Up next, TikTok has new investors at the forefront. The company looks to spin off its U.S. business. More in a moment. TikTok's parent company ByteDance has cracked the code on avoiding a ban in the U.S. The company is signing a deal to spin off its U.S. business. Among the investors are Silver Lake, MGX, and Oracle. Let's bring in Jim Anderson. He's co-founder and CEO of Beacon. Thanks for joining us today.
Good to be here.
So each of these firms get a 15% stake in ByteDance, but MGX is out of Abu Dhabi. So is there enough of a dispersion of ownership to put American concerns to rest?
Well, you would hope so. I would look partly at the ownership. I'd also look partly at the governance and the board of directors. They have said that the board of directors that are going to control that is going to be American dominated. There's not a lot of specifics there. But interestingly, and I think this was probably important as part of the negotiations between the U.S. and China, ByteDance and its affiliated investors still own more than 50%. It's slightly more than 50% of the company. So you've got sort of a predominantly Chinese and Chinese affiliated ownership and then predominantly American governance, and that strikes me as a compromise, right? That's what they've been hashing out for the past several months.
Okay, so Jim, what does Oracle get out of this?
Well, Oracle gets a stake, and obviously they got a boost in their stock price because there's lots of concerns about their exposure to a few companies, and so obviously this TikTok's one of the most successful commercial applications out there, and to the degree that Oracle is providing a lot of the technology and the cloud computing, and just more broadly the compute, that's a good deal for Oracle clearly, and that's what Larry Ellison and Oracle clearly has been interested in for a long time here.
Tell me about Silver Lake.
Silver Lake, it's interesting. I think you have to imagine there was a lot of political connections at work here. I mean, clearly this was got the eyes and the attention of President Trump. He issued repeated executive orders to provide more time against a duly enacted U.S. law, saying that that they were not allowed to do what they were doing, and so he basically put off enforcement of any of that. And you have to believe the people at the table, including Silver Lake, are pretty well connected politically and to those conversations. So there's a lot of sources of money, and I think the sources of money here, came from, as we saw, multiple different places that were all very well connected to President Trump.
Do you think that there were other contenders, and if so, who would they have been?
Yeah, there were many other contenders. Lots of people wanted to get a seat at this table, and Microsoft was probably the biggest name that came up early on. But for whatever reason, probably antitrust and other reasons, that was not a winning play long term. But I'd be willing to bet if you said, okay, who's the list of companies that would have been interested, it would have been easier to compile a list of companies that were not interested. It would be much shorter, because who would not? Any tech company would love to be affiliated with an app the size, scale, and the algorithmic intelligence of something like TikTok.
So do we know if China is on board? I know the deal is expected to be signed sort of end of January. Has Beijing said it's on board with this?
They have not said, at least it's been publicly reported, but the fact that they came up with a January 22nd closing date, right? I mean, it's December 19th, so January 22nd, that's an extraordinarily short window to close. So I think that's a pretty strong signal. I'm having a hard time imagining they would have come out with that as a close date if they didn't already have either tacit approval from the Chinese government or even explicit approval from the Chinese government that's not yet been made public. And again, this has always been a deal between the U.S. and China, right? This is geopolitics, and as big and as successful as TikTok and ByteDance are, they are pawns on the chessboard between the U.S. and China, and I'm sure they're very happy to be in a position where they can be out of that limelight and be off running and growing their business.
My understanding was that, of course, the American information being at risk, they wanted to have an American place to put that information to secure it from being compromised. So if that is now secured, what about the algorithm? Who gets control of that?
Yeah, well, I think that's actually the bigger concern. Everything on the internet is one click away from anywhere in the world, right? So the fact that the data is housed in the U.S., I'm not saying that's not worth anything, but that's really not that big of a win, honestly. I think the far bigger concern has been the algorithm, right? That's what's differentiated TikTok. It's remarkably successful, and that algorithm programmed so that what you see in your TikTok feed, what I see in my TikTok feed are going to be very different because we have different interests, and that's a remarkably effective algorithm. That still is not specified. You have to imagine that ByteDance controls the algorithm sort of holistically, but there are notable statements that the U.S. governance, the board that's going to govern the joint venture, has control over the ability to see that algorithm, to train the algorithm, and ultimately some of the inputs into that algorithm. And again, it's a very messy compromise that's not clear at all, and it's probably not clear to the people who have to make it work as well. But if the alternative is shutting TikTok down in the U.S., which was a real alternative, even a messy outcome is really a big win for the company.
Do you see this model then being used in other countries? See how it rolls out sort of in the U.S. and for the same reason being rolled out in other countries?
Yeah, I think it will definitely be a benchmark that other countries who have the same concerns can use, whether they have the same negotiating leverage with China, because ultimately, remember, China has to sign off on every one of these deals, China, the country, and the government, not just ByteDance, the Chinese company. So if it's in the Chinese government's interest or perceived interest to sign off on a deal with another jurisdiction, then maybe. But I'd be hesitant to say, oh, this is the new benchmark and it's going to be followed elsewhere. It is a path that has been followed and might work for other countries, but I wouldn't necessarily presuppose that.
All right, Jim Anderson, appreciate you joining us today. Jim is the co-founder and CEO of Beacon. Coming up next, a new report from the Fraser Institute shows Canada's stock market is shrinking, but market cap on the index climbing. So we'll talk about what that means in a moment. Here are the stories we were following in the newsroom. WildBrain, a Canadian media and production company, has agreed to sell its 41% stake in the Peanuts franchise to Sony Music Entertainment and Sony Pictures. The deal's worth $630 million in cash. WildBrain says the funds will fuel growth in its wholly owned franchises, including Strawberry Shortcake and Teletubbies, as well as expand its digital network and ad footprint. KB Home posted an impressive profit in its latest quarter. The house building company reported an overall lower average home selling price, a decrease in year-over-year revenue, and a shrinking in profit margin. The CEO pointed to housing market conditions and low consumer confidence as challenges. Nike warned sales will decline this quarter. Nike now expects revenue to be in the low single digits because of persistent weakness in China and at its Converse brand. Converse sales plunged 30% in the latest quarter, while Greater China revenue fell 17%. Nike's direct-to-consumer category also disappointed. FedEx posted estimate-beating revenue in its second quarter. The shipping and logistics company's outperformance in both profit and overall sales led them to raise the low end of their profit outlook for the year. On the downside, FedEx has been grappling with a string of cost headwinds, including the grounding of its MD-11 planes. The company says it expects roughly $600 million U.S. in a hit to earnings in the second half of next year as a result. For more on the earnings for FedEx, we're joined by Jeffrey Kaufman, equity research analyst at Vertical Research Partners.
Peak season finally showed up, and they were talking about holiday volumes up mid-single digit. I think the company did a terrific job of growing revenues a little bit better than the consensus was expecting by almost 3.5%. They did it through a combination of volume was better, yield was better. They're ramping up some of their Amazon business. And at the end of the day, it was a very solid result for the parcel and express part of the company. The less than truckload business continues to struggle because domestic manufacturing's been weak, and we're seeing that in competitors such as ODFL and XPO. So we're not surprised that the LTL volumes were a little bit light, but for the second quarter, the express business did offset the negatives on the less than truckload trucking side.
And with this margin improvement, is it something that can continue, or is this just more cyclical?
I think it can continue. I mean, especially since it was both volume and yield. It wasn't any one thing, and it wasn't even so much the cost cutting yet, because they still have a lot of their integration of facilities still to do. And that's going to be the next 6 to 9 months. I think only about 30% of the integrations have been completed. So you're going to go from 1,300 facilities to about 800 facilities combined between express and ground parcel. So there's going to be significant cost savings as we go into 27 and eventually into 28. So we really like what we saw. I think the reason the shares are in the red today, not the green, is because they did announce, along with the really good earnings, that it was going to be more tempered next couple quarters because of expenses related to the spin of the LTL business that will happen in June, as well as kind of a problem of success, higher variable incentive comp to the employees based on them exceeding targets in the express business year to date.
Any concerns with that LTL when it comes up in June?
No, I think they're one of the leading businesses. It's a great business. The entirety of the U.S. trucking business has struggled for about 2-3 years. I think some people call it a freight recession. We just kind of look at it as more of a lack of consumerism and a lack of manufacturing activity. But this business in the long run is going to be fine. They have one of the better operating subsidiaries in the country. And the way we look at it is, with the spin coming in about 5.5 months, you really need to look at this on a sum of parts basis. Based on the earnings we think the LTL company is going to generate and peer group valuations, we think the LTL business is worth about 110 per FedEx share today. Mm-hmm. So if you work backwards off the current stock price at 274, that means you're paying about 10.25, 10.5 times earnings to own the parcel company, or what we would call RemainCo. And we don't think that's the right multiple. They showed us today or yesterday that business is good. They're expanding margins. They're growing share. I think that's a business that should trade between 13.5, 14 times earnings. So we think that business is worth about $230 a share post-spin. And when you combine the two, that's about $330 per FedEx share. So, we do see upside even after the run the stock's had for shareholders going into the spin.
Do you see them getting to that multiple that you'd like to see?
I think so. We always get low multiples when freight markets are slow, and those multiples always come back when freight markets normalize. So I would view that multiple as really nothing more than a cyclical bottom in an industry that kind of depends on global trade.
And speaking of that, is that global trade, is that any kind of a headwind, concerns for a headwind there?
It is over the near term. If you segregate the results in the parcel business, the domestic parcel business grew 5.5%. It was very strong with solid volume and solid yields. It was the international part of that business that actually declined about 2%. And I think that's something they're going to continue to work through, because there was some pre-shipping that occurred ahead of the tariff deadlines. And you've got some very difficult comparisons over the next 6 to 9 months, because you'll be comping against those strong periods. But I think when we get to fiscal 27, we're going to be through those difficult comparisons, and we're going to have a business that's going to be restructured and generating better margins and generating better cash flow. And I think investors will look at that and say, wow, this is a good business. We should probably pay a little more to own the shares.
Jeffrey Kaufman, equity research analyst at Vertical Research Partners. Coming up next, a new report from Fraser Institute takes a look at Canada's stock market and how it's shrinking. More in a moment. Is Canada's stock market shrinking? A new report by the Fraser Institute highlights a drastic drop in publicly listed companies from the early 2000s. Let's go to Ben Cherniavsky. I wanted to get that correct. Partner at Fort Capital, co-author of this report. Thanks for joining us today.
Thanks for having me.
Can I first ask why you started a look at this at 2008? Why that parameter?
Well, frankly, it's as far back as the data are available from the TSX. I think it also provides an interesting milestone with the financial crisis unfolding at that point in time. I mean, the full impact of the GFC wasn't really evident until 2009 and 10. So I think starting at 2008 gives you a look back as to what the markets looked like pre-crisis. And obviously, it's almost 20 years now, so a sufficient number of data that could tell you a long-term trend.
Got it. So there are a number of reasons that you noted for fewer listings. What would be the biggest one?
Well, I think the market, the drop in market listings is really telling us two things. One is that many companies that are still growing and choosing or in need of capital and choosing to raise capital are opting for alternative sources, increasingly opting for alternative sources of capital, namely private equity, family offices, and pools of capital like that have grown exponentially over that same period of time. That in itself raised a whole bunch of other questions as to why companies are choosing private equity money over the conventional IPO, which has always been designed to maximize value. And we explored that in the report. But the second thing I think that the trend tells us is simply that there are fewer companies growing in Canada. I think we believe this is a symptom of Canada's economic malaise to see fewer listings and fewer public companies. And in fact, what we also find is fewer equity issuance. Even amongst the companies that are listed, they are issuing less and less equity. The only reason you raise equity is to grow your business. But if the growth environment is lackluster, you don't need to raise capital. And in fact, the other thing we point out is increasingly companies are buying their stock back instead of issuing more stock. And so that's to us pretty convincing that this is also symptomatic of Canada's low productivity, our meager growth per capita, and all the economic issues that are becoming more and more pertinent by the day, frankly.
Okay, so let's talk a little bit more about that. Part of it, I imagine, is just regulation, lack of government support, too much red tape?
I think when you look at why companies that are raising capital, even though that may be a smaller number, we still have some companies, we still obviously have growth companies in Canada. When you look at why they're choosing to pursue the private equity markets over the public markets, I think there's a very convincing explanation that they are avoiding IPOs and the listings because of the regulation and the cost. That's really just gone in one direction over the last 15, 20 years, namely up more and more regulation. And as you pile that on to public companies, especially smaller ones, typically when you go public, you start from a smaller base. The whole intention is to go public and grow and become a bigger company. But those costs are disproportionately burdened on smaller companies. And so even though you may be able to maximize your upfront value through an IPO, the recurring costs, and frankly, the recurring sort of intrusive nature of the regulations, we get into some of that governance and securities regulations that are putting sand in the gears of being public, is just creating more and more disincentives to go public. And when this growing pool of capital is out there where you can align yourselves with private equity investors who are primarily, if not exclusively, focused on maximizing shareholder value, as opposed to a long list of other things that public companies are now encumbered to do, owners of those businesses, it would be rational that they would choose private equity as their source of capital.
I know, and you also noted the movement towards index investing as opposed to investing in actual stock. What did you find?
Well, I think everybody knows index investing is growing dramatically. I think one estimate we found was approximately half of the capital globally that's invested in the markets is invested passively in ETFs. I think where that relates to the study that we published is that it comes back to the disincentives to go public. And what's happening is the companies that are public are generally bigger companies. The bigger companies are getting bigger and the smaller companies are disappearing. Part of that, as I said, is that upfront disproportional cost of being public that gets burdened on a small company creates a disincentive. But also, if you're small and you're not in an index, nobody really cares anymore. And so we're seeing this increasing number of orphaned public small cap companies, fewer small cap stocks, fewer small cap managers, all a reflection of money flowing into ETFs. And that then just piles on to the problems that these smaller companies face in the public markets. And I think, our report doesn't suggest there's any real resolution or public policy changes you can make to stop the trend in passive investing, where that trend necessarily should be stopped. But it does, I think, raise the urgency to deal with the regulations, because the small cap companies are already getting burdened with the index investing, and you pile on top of that the cost of regulations, and it just makes it increasingly unattractive to go public, where again you can find growth capital in the private equity world.
All right, Ben, I've got to leave it there because I'm out of time, but thanks for your time. Ben Chernyavsky is partner at Fort Capital, a co-author of that report. Shares of WildBrain shot higher today after the media company from Canada announced it's selling off its stake of Peanuts to Sony. Let's go to BNN Bloomberg's Lindsay Biscaya with more on that.
Yeah, so WildBrain is selling its 41% stake to Sony for $630 million Canadian. And this means Sony will now be taking an 80% stake in Peanuts. And then the family of the founder, of the creator of Peanuts, has that 20% stake in the company as well. This comes after a $345 million acquisition in 2017 when WildBrain originally bought Peanuts. Now, Peanuts, for those who don't know, is worldwide famous for its comic strip, including Charlie Brown, Snoopy, the whole gang, first introduced back in 1950. WildBrain is the company behind shows like the Teletubbies or Strawberry Shortcake. And WildBrain is saying these funds, the $630 million in the sales that they're making, they're going to put back into Strawberry Shortcake, Teletubbies, and also helping to expand its digital footprint. They say it will also eliminate 100% of its debt, leaving more than $40 in a cash surplus. The deal still subject to regulatory approval, but this doesn't mean that the characters you love, like Snoopy and Charlie Brown, are really going to change. We heard from the CEO and president today of WildBrain saying that these characters are in good hands when it comes to Sony, and under this agreement, WildBrain still remains a partner to Peanuts. So that includes exclusive licensing for consumer products in certain countries, as well as a distributor of WildBrain-produced Peanuts content and continued management of the Snoopy YouTube channel. And they're also going to operate an exclusive production studio for new Peanuts content. Back to you.
Lindsay Biscaya reporting. All right, coming up, hot picks in aerospace and defense, including a French company that manufactures military aircraft engines and missile propulsion systems. Back in a moment. Time now for hot picks in aerospace and defense. We were joined by Ken Herbert, analyst at RBC Capital Markets. And we kick things off with French aerospace and defense company Safran as his top pick.
It is a leader in aircraft engines, and obviously the services associated with that. So it is expecting to see a doubling of its equipment defense sales in Europe, which we think obviously gives investors good exposure to European defense spending. It has, of course, a broad portfolio, but very commercial aerospace focused as well, where we remain very bullish on the fundamental outlook, both for new build aircraft as well as for the aerospace aftermarket.
Right. And that's interesting. So it participates. Sorry, what kind of civil aviation engines does it make?
Yeah, so it is a 50-50 joint venture in CFM International, which provides predominantly narrow-body engines. So think about the engines on about 60% of the A320 neo fleet and about 100%, obviously, of the Boeing 737 MAX fleet. That's what it's most well known for. It also produces parts for wide-body engines, as well as, to your point, a host of business jet and military engines or propulsion systems for helicopters, for aircraft, obviously, so across the board. But on the commercial side, smaller narrow-body aircraft engines are perhaps what it's best known for.
RTX, big in missiles, used to be Raytheon or part of Raytheon. What attracts you to this stock?
So RTX, we really like the mix, again, about 50% commercial, 50% defense. Within its defense business, its book-to-bill was over 2 times in the most recent quarter. It is the #1 supplier of missiles here in the United States. So when you think about major new program starts like Golden Dome, you think about a lot of the restocking effort that's happening in the United States. It's a direct benefactor of that as well. And certainly when you think about international sales for key products like the Patriot missile, it's very exposed to that. So we think it ticks a lot of the boxes in terms of where we're seeing growth in defense markets, where it's very well positioned. And again, it also has significant commercial exposure. And we like that diversity right now because we do think we are seeing growth continuing in aerospace, certainly into 2026, and we like the portfolio mix within RTX very well.
And so again, they are a play on both civil. They have a civil franchise.
They do have a civil franchise. They obviously own Pratt & Whitney, which makes a number of civil aircraft engines. They also, of course, own Collins Aerospace. That and Raytheon are their 3 main segments. And Collins is a big diversified supplier of aerospace products, so everything from seats and galleys and interior equipment up through all kinds of systems and avionics and elsewhere. So again, diversified play, but we do think the defense piece within RTX is really where we see the most upside into 2026.
And then finally, a company called Loar, L-O-A-R. What do they do?
So Loar is a small component supplier, predominantly 70% commercial aerospace. They do everything from seat belts and other systems on commercial aircraft, predominantly a play on the aftermarket. So that is the majority of their aerospace sales. They do have about 25% of their revenues as well from business jets, but Loar significantly benefits from new product introductions, which has enabled the business to outgrow peers. But I think most importantly, it represents a way to play what we expect to be continued consolidation in the aerospace marketplace. The company has announced a significant acquisition that should close here in the near future, and we think future acquisitions will help the stock reverse what's been, as you can see from the chart, a bit of a sideways move over the last 6 months. But we think Loar as well on the small cap side is very well positioned.
I mean, could you generalize, over the years, have U.S. defense stocks been decent investments, or are they cyclical, or do they rise and fall with the political winds?
They've tended to be cyclical, right? In fact, in some ways, they're counter-cyclical with the broader economy. We like to say defense stocks are defensive. We do think, even though we're seeing substantial growth both in the United States and internationally in defense spending, they will remain cyclical. And there are a number of competitive pressures, and to your point, political factors that influence, obviously, sentiment on these stocks. So they are certainly cyclical. They'll continue to be cyclical. But we like the outlook from a fundamental standpoint now in terms of defense spending globally, and of course, certainly in the United States.
One name that always comes to mind when I think about defense is General Dynamics, GD, the maker of the Abrams tanks and lots of other defense systems. And that stock sure has had quite a good run over the past 10 years. I'm not sure if we can show a 5 or 10 year chart.
Yeah, I mean, business perhaps best known here in the United States as well for its Gulfstream business jet franchise. And I think the outlook for business jet travel has certainly seen some pickup here in 2025. I expect that to continue in 2026. Gulfstream very well positioned at the upper end of the market, right? So specifically with corporate travel and high net worth individuals. So yeah, and also, of course, to your point, very strong franchises in shipbuilding and in combat systems as well, which are both in relatively good positions as we think about broader defense spending.
Would you be a buyer of General Dynamics right now, or are you less keen on that stock, Ken?
We're less keen on General Dynamics right now. We've got a sector perform rating. We prefer RTX for sort of prime exposure here within the defense side.
Ken Herbert, analyst at RBC Capital Markets. Canadians are being aggressively targeted by AI-generated videos to invest in cryptocurrency scams. A W5 investigation has found some investors have lost their entire life savings. Part 2 now of CTV's Pat Foran's report.
A 51-year-old woman we call Denise is about to lose her home and has no idea where she, her husband, and 2 children will live. She's devastated after losing $1.7 million to a cryptocurrency scam she saw on Facebook.
It looks so real, but now you don't know what is real and what is not real.
Donald Hanrahan says his life has changed forever after losing his life savings of $600,000 after also seeing a fake AI video.
It means my lifestyle is completely changed. You know, that amount of money can do quite a lot at my age.
CTV News contacted Aaron West, a former U.S. prosecutor who started Operation Shamrock, a nonprofit group that travels the world investigating scam call centers, fleecing Americans and Canadians of their money.
And so what they've done is they've created a new business that is the most lucrative business that they've ever created. And it involves stealing a generation's worth of wealth from the rest of the world.
West traveled to 2 cyber fraud compounds in the Philippines within the past year and was shocked by the scope of fraud activity.
It's more than 35 buildings and was designed and built for the sole purpose of scamming. It's eerie to be in rooms that I know were responsible for stealing billions of dollars.
West says while some may find it impossible to believe victims could lose so much money to investment scams, she says the months of grooming takes its toll.
There's significant contact between victim and scammer in the middle of all this that really is able to convince a victim that they are experiencing something really special and different, and that they have an opportunity. They've been sold a dream, and they want that dream.
While Canadians are being victimized, West says many of the people doing the scam calls are victims too often of human trafficking. They're forced to make scam calls 16 hours a day, and if they don't or try to escape, they're beaten or tortured.
I only know that if you don't work and don't do as they tell, you get beaten.
An Amnesty International investigation identified more than 50 scamming compounds in Cambodia. They were also able to document the abuse workers suffered if they refused to scam people.
And the torture inside these compounds is extreme. And so that's how you motivate people to do something that they would not ordinarily do.
West says Meta and other social media companies are not doing enough to remove AI-generated scam content from their platforms.
Meta is enabling these bad actors to reach their prey, which is unsuspecting normal people.
CTV News reached out to Meta, and a spokesperson said, "It's against our policies to run ads that deceptively use public figures. We remove scam ads when detected and don't want this content on our platforms. As long as fake videos can be viewed, more Canadians will fall victim and lose their life savings too." Pat Foran, CTV News, Toronto.
All right, let's have a look at where the markets ended the day. The TSX gaining 314 points to end the week with a new record close of 31,755, so up a full percent today. Let's go to the U.S. It's in the green today as well. The S&P 500 gaining 59 points, or 0.9%. The Dow Jones moving up 183. That's 0.4% of a move up. And the Nasdaq gaining 301 points. That's 1.3% up. A quick look at Oracle, which moved up today as well on news that it will share with a consortium some ownership of ByteDance in the U.S. So that news came out late yesterday. That moved the stock up today 6.6%. That does it for the close today. Thanks for joining us. Have a good weekend. We'll see you Monday.